Thanks for coming and staying back with us. This is, of course, the Shariah Investing Virtual Conference 2020. We've had a rather fruitful morning session. If you've just joined us, to recap, we had a long session on the principles of Sharia, where some of the panel experts actually shared the view of the market, view of the scholarly opinions, as well as their personal opinion on a lot of issues. One standing issue is, of course, short selling and whether or not and where it stands in terms of Sharia investing. Another one is, of course, the returns of Sharia investing versus conventional investing, the returns of conventional versus the returns of Islamic. Those are happening right now. For this session, we'll be talking about how Sharia investing is going to meet or doesn't meet global agenda, and that's part of the whole historical argument that we have right now. Does it serve the global agenda? When we asked the second poll just now, does end-to-end Sharia compliant investments matter to you? 90% of you said yes, Sharia end-to-end compliance does matter to you. So now how do we put that into the practical application of it? How do we make sure that Sharia investing does meet the global agenda? If I can invite some of my guests now, I think all of us are ready. Can we bring in some of the guests right now? Adil, the head of Islamic finance of Refinitiv, Dr. Muhammad Eskandar Shah. He is, of course, associate professor and associate dean of the School of Graduate and Professional Studies at INSEF. Helena Fung. Helena, thanks for taking the time to speak with us. She's from FTSE Russell, head of sustainable investments there. And of course, Damshal, who is with us, broadcasting live from Bursa Malaysia in Kuala Lumpur. Damshal, thanks for taking the time and riding the road, joining us. He is, of course, the CIO of Tabung Haji. Let's jump into the first conversation right now. May I invite Associate Professor Dr. Muhammad Eskandar Shah. Dr. Eskandar, let's talk a little bit about uncovering the basis of slower growth of the Islamic capital market. Where do you think would be the epicenter of growth would be, and how do we raise the bar higher?
Okay, thank you so much. Is it loud and clear from your side? Okay, all right. So, good morning, everyone. Assalamualaikum warahmatullahi wabarakatuh. So, first of all, thank you so much to Bursa for this opportunity, and good morning to fellow panelists as well. So, I'm wearing two hats now. One as a consultant to the World Bank, and also the associate dean at INSEF. So, bear in mind, as a consultant, my view is just a reflection of my own opinion, not really necessarily reflects the official stand of World Bank. So let me start. I mean, it's a very important question, and let me just continue the discussion that what we had in the morning. Perhaps before we look at Islamic capital market in the relative term and put it into the right context, so maybe we might want to establish a certain pretext to our discussion today. Obviously, if you probably look at the growth of ICM, relatively robust over the years. But if you try to put it relative to, for example, other form of investing, especially ESG, you can probably look at how small it is. No doubt, we have to establish the fact that capital market seems to be very important. In fact, if you look at this coronavirus and the pandemic that we are going through, a country that has a robust capital market and even banking system, able to probably withstand the health crisis and try and able to mitigate and rather than translating that into economic or even social crisis. So the premise that capital market is so important, and how we bring it to the context today that look at, for example, the growth of Islamic capital market. So before I give my thoughts and my view on this, I would rather bring through some of the data just to look at, how fast that we have growth over the years. Okay, next. Okay. Can you move on? The next slide, please. Okay. So just to put it into perspective, in terms of the epicenter of ICM over the years, it seems that the data and the stats seems to be consistent over the years. We probably look at Malaysia continue to be the leading nations in terms of driving Islamic capital market and also Islamic banking. Obviously, in the context of banking, Middle East is probably bigger than Malaysia, but when it comes to Sukuk especially, and also equity market, Malaysia seems to be dominating. And over the years, you can probably look at the stats. It shows that the same countries are occupying the top 10 positions. So what we can conclude from here is that it seems that the growth of capital market, or especially Islamic capital market, or even Islamic finance in general, seems to be driven by strong government support. So it's more towards a top-down approach rather than entirely driven by the market. So a country that able to have changes in regulations, and setting up various institutions seems to be leading the growth of ICM. So it seems that there is no connections, or there is a little connection about the sizable population of Muslim countries with the growth of capital market or ICM. For example, you look at Turkey, or even you probably look at Indonesia. They might have the sizable Muslim population, but not necessarily it reflect in terms of the growth of the capital market itself. So the conclusion I'm trying to make before we move on is that we need to really look at how we can grow the capital market, moving away from just strong institutional support and regulation from the government towards something which is market driven as well. So if we can move on, next slide, please. Okay. Next slide. All right. So just to put it into perspective, if you really compare ICM, for example, despite all the robust growth that we had over the years, relative to ESG investing, we are just too small, I would probably say. For example, if you look at 2012, the total ESG investment is about 13.3 trillion, and it has gone up to almost 30.7 trillion in the span of 6 years. Okay, this is based on the Global Sustainable Investment Alliance as March of 2019. So I would probably say that we are not really riding the wave enough in terms of putting ICM into, I would say, mainstream. So before I go into my recommendation, so I would probably like to argue a few reasons of why Islamic finance or ICM is actually lagging behind. Number one, like what I said just now, is very much depends on strong government support. So if the nation doesn't want to really push Islamic capital market or even Islamic finance and agenda, it's really impeding that particular growth. Number two, I think the value proposition of Islamic finance or Islamic capital market has to be very clear. And ESG, for example, the value proposition seems to be quite straightforward and is quite attractive as compared to Islamic finance. Because when we talk about Islamic finance, we always talk about social inclusion, we always talk about social studies, and we talk about inclusion, we talk about resharing, we talk about asset backs, so on and so forth. So the question is that how do you show that these value proposition are more powerful or as good as ESG value proposition? So what is happening today is that there are two things that are happening in the context of ICM. Number one, ICM is trying to converge with ESG, in the way that we are trying to push for green suku and social impact suku, so on and so forth. In a way, they're trying to basically attract a large group of investors in terms of branding ICM or branding Islamic finance together with ESG. But I would also like to bring into another perspective of how we can actually build ICM. Maybe another way of looking at it is that, especially in the context of what we are going through today with the pandemic and with the high debt level, so on and so forth, can Islamic finance or can Islamic capital market stand alone and can be more successful with its own value proposition, which I think, and more focus on redistribution of wealth, social justice and financial inclusion, so on and so forth. And quite a number of works is actually being done. For example, in World Bank, they are trying to look at how Islamic finance can support inclusion. how Islamic finance can develop, for example, sustainable city, and how Islamic finance, for example, can support some of the infrastructure project that happening, and how Islamic finance can be used to support affordable housing. So what I'm trying to say here is that what is really important today is that we have to make it very clear what is exactly the value proposition of Islamic finance. If you can move to the next slide, so please. If you can move to next slide. Next slide, please. All right. So, I mean, again, this is just reiterating my point. When it comes to Islamic, the growth was only about 4.3% a year in average, 4.3% over the span of 12 years. But when you look at ESG, for example, the growth is almost about 10.2%. So it's almost double in the context of ESG and also Islamic finance. So it means that, you know, if this trend continues, either Islamic finance will just become a subset of ESG, or eventually people will just brand Islamic finance in the context of ESG as well. So rather than become a brand by itself. So it's not a worry for me. It's not a concern. It's just a one track that we can actually use ESG to promote Islamic finance as well, because they're quite a substantial overlapping in terms of value proposition. But also I want to highlight or reiterate the point that there are a sizable market of people who are going to ICM just because its own value proposition, not just because of religiosity or spirituality. What I would probably say that people are attracted to Islamic finance because of a broader agenda, for example, reducing inequality, you know, social justice and inclusion, so on and so forth. But the question is that how do we sell those ideas? So a country that able to position Islamic finance, especially Malaysia in that particular context, would be able to attract these kind of investors who believe in this value proposition. And especially after this coronavirus, we can probably see that countries that suffer not just because of health and translate into economic crisis and translate into social crisis are those countries which have a high level of inequality, you know, and they were not able to provide a good support system. But country like Indonesia, for example, because they have a proper redistribution system using wakaf, suku wakaf, blockchain, you know, using zakat and all those things, it seems that they're able to mitigate some of the impact. So we see the relevancy of Islamic finance, or we see the relevancy of ICM in the context of what we are seeing today. And the last point which I'm trying to make before I pass it back to the moderator, if you can move to the last slide. Can we move on to the last slide? Hello, can we move on to the last slide? Okay. So the last point that I'm trying to make here is that if we really want to become the epicenter, allow me to use this term, we should not be trapped into what we call as the emerging market dilemma. Obviously, when you talk about emerging market dilemma, is that it seems that emerging market seems to be a hotspot for hot money, and people are just looking at short-term investment, you know, just to make, for example, a quick return, you know, out of possible upside from that particular market. And whenever you see the crisis, you know, there are a lot of net outflow from that particular market itself. And probably we can also observe the same in Malaysian market too. You know, if in fact over the months, the net outflow, you know, this is just based on my observation by reading the market from the newspapers, the net outflow of the foreign investors seems to be quite substantial over the years. Thankful to significant liquidity in the local market, you know, we are able to basically, you know, hold our stock market performance. And I'm sure the same thing will happen in other parts of the emerging market. So we should not fall into that trap. So what I'm trying to say here is that one of the value proposition of Islamic finance, or also Islamic capital market, should be aligned with what Islamic finance is all about. You know, based on proper governance, you know, high level of trust, and more importantly, it should be able to show high level of impact assessment. And with that, I would probably see that, you know, the investment that coming into this market is not just because it's looking at short-term upside, but more importantly, it believe in what Islamic capital market got to offer, you know, apart from it just a business value proposition. I do understand, end of the day in life, return is, the most important thing. Risk is also the most important thing. As somebody who have studied finance all my life, I believe the same thing as well. But then we see the world is changing. We see that, climate change is becoming even more important. Biodiversity is also becoming even more important. And apparently, people have argued that, one of the reasons why we're having this coronavirus is that because the animals are getting closer and closer to us because we are destroying their biodiversity. And climate change is becoming even more important. And we see riots because of social inequality. So what I'm trying to say here is that, people are realizing that, it's not just about risk and return, but people are realizing about continuity of the society as a whole. Social cohesion, social mobility are becoming even more important. So for Islamic finance, for me to move forward, we need to build better governance, better trust, and also show a high impact assessment. And obviously, Malaysia can lead in terms of being a leader in Islamic finance. But I believe that we have to do more, especially in the context of governance, trust, and also we need a proof of concept. How, for example, ICM can build a sustainable society in Malaysia. And then that proof of concept can be used, to challenge or to basically to complement what we call as a ESG investing. Because for me, last statement, for me, ESG investment, the proof of concept is very clear. The impact assessment is very clear. So can we do something like that with Islamic finance? How do we link with SDG? How do we link with ESG? And how do we link with SRI? And more importantly, how we do link with continuous development, not only at the higher level, but also at the lower level of the society. So for me, that's what it's all about. I believe that there's huge upside for capital market, Islamic capital market, because relatively it's very small. I know we have a temporary shock, like petrodollars is drying up, but eventually when all these things back to normal, we really have to revisit what is exactly our value proposition and make that value proposition as attractive as ESG. So with that, Mr. Moderator, thank you so much, and I'll pass it back to you.
Islamic finance of Refinitiv. Mustafa, we want to understand the notable recent developments of global and local events, Islamic equities, and let's bring into some insights of the new developments that has been impacting our market, perhaps some innovations and trends into the Islamic equity markets. Mustafa.
So, thank you very much, Bismillah ar-Rahman ar-Rahim, and I think I will start with the presentation. So, essentially, I've been tasked to look at, what has been some of the recent developments that have taken place in the global Islamic equities market and some of the key trends that are emerging that would be significant for investors to consider when they're looking at this space and when they're looking to build out a balanced portfolio for themselves. So, I think if we move to the first slide, what I want to do is I want to start from a twofold system. The first thing is really understanding the crisis. And this is very important because the natural instinct for every individual and every investor is to compare the current crisis with the global financial crisis that took place in 2007, 2008. And that is a fundamental mistake and a misunderstanding of the underlying dynamics of this particular crisis, right? We cannot compare the crisis, and we cannot, more importantly, project the trends that emerge out of that crisis to be mimicked in this particular instance. So it's very important from a foundation building perspective for us to really understand what we're dealing with before we start to analyze some of the trends that are taking place in this space. So if we move to the next slide, it's very important to understand that first and foremost, this crisis is a healthcare crisis. And a healthcare crisis is very different from a financial systems crisis, right? We know that in 2007, 2008, there was a fundamental misalignment in the financial system. There was excessive leverage. There was debt without any value to underline it. In fact, the value was declining, whereas the debt was increasing. There was a misalignment of allocating risk and sharing risk appropriately amongst institutions, and the financial system needed a major correction to be able to deal with that crisis. The response to this crisis is going to be very, very different because it fundamentally starts with a healthcare crisis, right? And these figures are, it's sad to note that these figures are dated by just a couple of days when I submitted my presentation just 2 days ago, and now the confirmed cases have already exceeded 7.9 million cases. Deaths have exceeded 435,000 deaths. It's staggering. And as you can see from this graph, it affects every single economy. This is a World Health Organization graph. No country on this graph is safe from this particular crisis, right? It exposes everybody to this. Now, if we move on, what has happened is that the healthcare crisis has evolved into a economic crisis, right? And this economic crisis is impacting the very, very basic fundamentals of economic growth or economic drivers. It's affecting demand significantly. It's affecting supply chain with a number of challenges that are emerging. It is affecting trade because barriers are going up, restrictions are going up, logistical limitations are going up, and certain sectors are being encumbered altogether. Things like tourism, things like F&B, entertainment, etc., are being hindered very, very significantly. Things like education and other sectors. And we can see this effect throughout the world. So, I've put in a number of indicative indicators on this graph, everything from the MSCI World Indicator down to some of our local markets like Malaysia and Saudi Arabia. Every single market has been impacted and equity prices have been impacted. This is a economic crisis that is impacting all markets. And the other challenge now is because economies are so much more in debt than they were back in 2008. I mean, global debt at the end of 2019 exceeded $255 trillion. That's 320% of the global GDP. It's 40% higher than what it was in 2008, right? So that significantly limits the levers of countries to tackle this. Despite that, a number of markets are doing their part. $11 trillion have been mobilized so far in terms of economic stimuluses. There's another $5 trillion that people are talking about in the pipeline. So there is, governments are trying to tackle this. But once you tackle the core crux, which is the healthcare crisis, you will see impact on the economic side. So the recovery from this one should, God willing, be much faster if the healthcare issues are addressed. Because, as I mentioned, it's not a issue of a fundamental misalignment within the financial system. It's an issue of basic economic factors being impacted by an external event, which is the health crisis. And if we continue move to the next slide, the thing that has also happened is that this economic crisis has evolved into a commodity crisis. And, there are over 90 countries in emerging markets where commodities make up more than 50% of their exports, right? Commodities is a very, very significant part of the overall structure of emerging markets and for Islamic markets as well. And as long as a commodity crisis persists, that is going to have an impact on government spending, that is going to have an impact on government budgets. So even governments that are looking to tackle these issues will need to be concerned because they don't have the budgetary tools available to the same extent. And while the economic crisis might alleviate faster, the commodity crisis may be prolonged. And this is where we have to segregate the different components of the economy. And all of this stuff is basic items for investors to consider when they're trying to project what to do in their particular market. So with that, overview about where we are today, let's look at some of the recent trends that have happened. And if we move on to the next slide, what I will do in my presentation is I will cover 4 key trends that we have seen that have emerged recently when it comes to investors looking at Islamic equities. And the first one, if we move to the next slide, is the actual performance, right? This is the natural way to start. And what I've done here is I have listed a number of global indices that are comparable between the conventional equities or the broader universe and the Sharia compliant equities, or those equities that meet Sharia compliant considerations. And as you can see from this chart, as you would expect, the indices follow each other very, very significantly. But the Islamic finance or the Sharia compliant equities indices have outperformed marginally, but have still outperformed their conventional counterparts, right? And I've taken the start of the year as the ground zero. So even in the first 2.5 months of the year, the performance of the Islamic indices was slightly better than their conventional counterparts. In terms of the volatility decline was roughly similar. And then in terms of the recovery, they have recovered better. So, instinctively, we know that through this crisis, Islamic equities do perform, albeit marginally, but do perform marginally better than conventional. What we also know is that, over the long term, studies have been done to showcase that there is a difference in performance because typically these equities are less leveraged. So therefore, in the medium to long term, they provide greater value for investors compared to the broader spectrum of the universe. And this is the first trend, the very, very simple one, to simply look at what has been the performance vis-a-vis the conventional side to get some basic understanding of how this works. The next key trend, or the next key consideration, if we move to the next slide, is what role will emerging markets play going forward, and how will that impact the equities market, right? Now, experts project that 44% of the growth that happens post this current crisis, this health crisis, is going to originate from emerging markets, right? And that's significantly larger than their proportion of economic contribution to GDP compared to their developed markets, right? And there's particular reasons for this. The first thing is consumption. Everyone projects that the recovery from an economic perspective will start from a demand-driven, consumption-driven recovery, right? And this is where having large, young population base will help drive that particular recovery, right? The second issue is valuations. So the valuations in emerging markets are significantly lower compared to developed markets. So the equity multiples, price to earning multiples, things of that nature are better. So what you can do as an investor is you actually have more potential for upside in this particular space because you're seeing this happen. And the third aspect is digitally connected. We all know that the crisis and the subsequent living standards and the way to work and the way to operate, which has changed, has forced us to be more digitally connected, right? A number of industries, have mentioned that coronavirus has been the biggest driver and push towards digitization, more than board strategy or executive strategy or, analyst feedback or anything else. This has been the key driver, right? We are becoming more digitally connected. And we are more digitally connected in emerging markets than we are in the developed world. Developed markets are still less digitally connected compared to us in terms of internet penetration, and a key consideration for investors to be looking at when they look at equity growth. The third trend, which is very, very important to consider, is Sukuk. And, Sukuk is, without exception, the center point of Islamic capital markets. Most investors look at Sukuk as being a key tool for their portfolios, and it is very important for it to be there in their portfolios, right? And what we've seen is definitely Sukuk is less volatile compared to equity markets, both on the upside and the downside. So you can see in this graph, the two indices that measure Sharia compliant equities, the S&P index and the Dow Jones, are fluctuating much more significantly than the two indices that track Sukuk, the Dow Jones Sukuk and the TRL Sukuk index. So definitely, you do have more volatility, but there are a couple of considerations why increasingly equities should be a bigger portion of your portfolio. One is that as the market recovers, the projection for equities to recover is more significant. The second consideration, which is very important, is regarding the broader environment that we find ourselves in, right? We all know that we are going to be in a prolonged low interest rate environment in the medium term. That provides limited return on instruments like Sukuk. We know that global debt has increased significantly, in excess of 320 times global GDP. That becomes another major challenge for institutions and for investors to consider. We know that asset qualities are declining. In 2008, triple B, when it came to corporate bonds, triple B and lower grade corporate bonds made up 25% of all issued bonds. Today, they're now over 50%. So asset quality of the debt being issued has significantly declined as well. And we've seen a lot of defaults in recent months. In the last quarter alone, the face value of bonds that have defaulted is exceeded $70 billion, according to the IIF. So, all of these considerations indicate that Sukuk is not going to have the same growth trajectory that we may have seen in previous years, and Islamic equities should be an important part of your balanced portfolio. And this becomes very significant. And if I move to my last trend, if we go to the last slide, please. What we're seeing amongst investors, what we're seeing amongst asset managers is increasing use of alternative data points, right? And what I mean by alternative data points is that analysts are using and investors are using other information that has not traditionally been used for making investment decision to be a key driver of that, right? So typically, you would look at GDP growth rates, rate figures, interest rates, things of that nature. But increasingly now, we're looking at alternative data points to make investment decisions. And the biggest case of this is the COVID-19 active cases and recoveries, right? I think every single analyst around the world, people are saying that this is probably the most quoted or most viewed statistic in the world in a very, very long time. Everybody is looking at this almost on a daily basis, and everybody's trying to pinpoint the bell curve and when we will go into the recovery mode. And that is, being utilized for all sorts of decisions, including investment decisions. Social media listening is becoming very, very important for assessing consumer sentiment. And increasingly, institutions are looking at social media listening for their consumer sentiment. CO2 emissions are being used as an indicator for manufacturing activity. So when the CO2 declines in a particular city somewhere in the world or in a particular region that is known for manufacturing, investors take that as a sign that the activity or productivity of that factory is declining, or that particular city is declining. So it makes an impact. It's seen as a proxy for manufacturing activity. And again, in terms of commodities, we're seeing transport and storage data being utilized to map things related to commodities. Dr. Eskandar, in his presentation, very importantly highlighted ESG as being a key convergence point that Islamic capital markets should look at. And ESG data is another one that is increasingly becoming directly influential when it comes to decision making for investors. So these were some of the trends that we have noticed that investors should be aware of, that investors should consider when they're looking at understanding where Islamic equity markets are going. And with that, I will end my presentation and hand it back to you, Ibrahim, to continue the session. Thank you very much.
We want to get some idea from you, audience that is watching this actually right now. We've asked to open the poll asking you if you think Sharia principle complements ESG. If you can just do that quick poll, we can move into the third panelist right now, Helena Fung. She is, of course, Head of Sustainable Investments at FTSE Russell of Asia Pacific. Helena, with the variety of stock indices available right now for the consumers out there, we want to explore the methodology and the computation of it, and particularly when we talk about an index, how do you guys formulate that into that collective? And of course, the complementary idea between Sharia and ESG in an index context. Helena.
Great. Thank you. Good morning. Can you hear me? Right, I'll go ahead then. So firstly, thanks to the organisers for the invitation to participate in this virtual conference, and indeed to the audience for taking the time to dial in. I think it's been a very interesting and fruitful discussion so far, and I hope that I can build on some of the excellent comments that the other panelists have made already, particularly as it relates to ESG and to sustainable investment. So as mentioned by Ibrahim, I'm going to speak in a relatively short space of time about the intersection of Islamic investing and ESG from an index perspective, so how both approaches can be applied within the context of passive portfolios. And I'm going to talk through a little bit the methodology for our FTSE Global Equities Sharia and Bursa Malaysia Sharia Index series, and then to look at the development of ESG indices and the constructions of FTSE for Good Bursa Malaysia Index. And ultimately, I want to draw both of these strands together to highlight how ESG and Sharia can work as complementary forces to further create enhanced opportunities for investors to achieve their ethical and financial objectives. Right, if we can move to slide 3, please. Thank you. I'll just start with a very brief introduction to FTSE Russell. We are the information services division of the London Stock Exchange Group. So we work across a number of interconnected businesses, intellectual property, risk and balance sheet management, and capital formation. And our presence across the financial markets, infrastructure value chain, allows us to provide a platform for investors across a range of areas, and including through FTSE Russell as a data and analytics provider. So in terms of our group credentials in Islamic finance, the London Stock Exchange is a key global venue for the issuance of sukuk, and a total of 72 sukuk have been listed so far on the LSE with a combined value of $53 billion US. London is the largest centre for Islamic finance outside of the Muslim world, and the UK was the first Western nation to issue sovereign sukuk. We have similarly strong commitment to sustainable investment, and we're part of the Sustainable Stock Exchanges Initiative. We published the first guidance for listed companies on ESG disclosure practices, and we're also a founding member of the PRI, the Principles for Responsible Investment. So we recognise that through the scale and the reach of what we do, we have a very significant position in the markets to be able to influence change for the better. We also partner with stock exchanges across the globe, and our partnership with Bursa Malaysia began in 2006 and encompasses a broad range of indices covering companies on the main markets in Malaysia and the ACE markets. So if we can move to the next slide, please. Thank you. So Sharia compliant indices themselves are a relatively recent development, with the first ones being introduced around the turn of the millennium. FTSE Russell began providing Islamic financial index series in 2000, which was incidentally around the same time that we began to provide our FTSE for Good index series. So we have a history of innovating in both spaces. We have a global range of Sharia compliant indices, and we screen about 9,000 stocks in the FTSE Global Equity Index series for compliance with Sharia principles. This is undertaken by YesR Limited, Sharia scholars and consultants. Now, we also calculate 4 Sharia indices as part of the Bursa Malaysia, the FTSE Bursa Malaysia Index series. And you can see these listed on the slide. They follow the same process as is set out here for the Global Sharia Index series. So for the FTSE Bursa Malaysia Index, Sharia Index series, we use the Malaysian Securities Commission Sharia Advisory Screening methodology. The exception to this is for the Hijra Index, where the companies need to comply both with the SAC screening methodology and also with YesR's methodology. YesR's selection of companies is compliant in accordance with the SAC principles, so there's no conflict here. In terms of methodology, as you can see, we start by screening all of the stocks in a benchmark universe for Sharia compliance. But apart from this step, the process is consistent with our standard methodology for index construction, which includes free float adjustment, liquidity screens, and is managed in accordance with a very transparent set of index rules governed by an independent index committee. So essentially, the Sharia Index series combines Islamic principles with an established financial criteria to make sure that they're investable and easily traded in the market. In terms of history, the EMAS Sharia Index and the FTSE Bursa Malaysia Hijra Sharia Index both launched in 2007. The small cap Sharia Index was developed in 2012, with the mid-S cap Sharia Index, which comprises both small and mid-cap stocks, launched in 2017 alongside the launch of a conventional benchmark. So the objective here is really providing choice for investors in the market that complies with their ethical investing principles. If we can go to the next slide, please. Thank you. And here, I guess picking up on something that the previous speaker has referred to already, wanted to give a brief comparison of some of the main Sharia indices in the FTSE Bursa Malaysia Index series. So this is the EMAS Sharia and the Hijra Sharia indexes. And again, I wanted to sort of start to address the question of performance. And this is a question that's regularly asked of ESG and Sharia investing. So in particular, how do they compare with conventional benchmarks? And I'll just say something about that as well. But just to give a brief overview and profile of these two indices. So the Hijra and the EMAS Sharia index and the KLCI, which is the third index profiled here, all take the FTSE Bursa Malaysia EMAS index as a benchmark. So they have a similarity in terms of the stock universe. KLCI consists of the 30 largest companies in the EMAS index by market cap weighting. So what you're looking at here is a large cap and an all cap Sharia index, the all cap being the EMAS and the large cap being the Hijra Sharia index. And as I said, there's some significant overlap in terms of the constituent stocks, but clearly the weightings are different between these. For the EMAS Sharia index, for example, you have a long tail of small cap stocks. Obviously, the other difference between the conventional benchmark and the Sharia indices is going to be exposure to industry. So for the KLCI, the top 20% of stocks is essentially comprised of 2 bank holdings, which are screened out of the Sharia index indices. So of course, there's a difference in the weightings between conventional and the conventional benchmarks and the Islamic counterparts. And as the previous speaker referred to, there are a number of studies on the performance of Islamic investments, but also on ESG. And I guess broadly speaking, if I was to summarize the results of those studies, both tend to indicate some level of outperformance. And there are certainly good reasons to assume that companies which are well managed and have lower leverage ratios would outperform in a difficult market environment. And towards the end of these charts, you can see a very nice uptick from both of the Sharia indices that are profiled here that complies with that idea. So management quality, we would say, is a factor associated with both good ESG performance and with lower leverage ratios. So again, in this sort of current COVID-19 environment, we have noticed, similar to what you see on the chart here, that some of the ESG indices, and particularly those focusing on low carbon stocks, which may be a factor of the current oil market, have performed comparatively well. But the other aspect of this is that ESG and sustainability benchmarks, as well as Islamic benchmarks, both provide positive impetus to the growth of socially responsible assets. And from a company perspective, inclusion in a Sharia or an ESG index can also encourage better performance on sustainability or ethical factors, as well as better reporting to stakeholders. So I would say ESG and Sharia indices share a similar benefit, which is transparency and consistency and application of principles from the bottom up. So there's another element of reliability there as well. Can we turn to the next slide, please? Thank you. So here I just want to highlight, moving on more to the topic of ESG indices, and a few elements that I think are quite key here. And that's included on the chart speaks to the development of FTSE Russell's Sustainable Investment Index range over the last 20 years. And I'm showing the timeline essentially to highlight the developments in ESG, but also the diversity and innovation in the construction of ESG indices. And this really mirrors, I think, the development of sustainable investing across the board, particularly with regards to environmental concerns and to climate change. So ESG obviously comes out of a wider background of ethical investing, which has a very long history. But it's also become particularly prevalent, I would say, in the years since the global financial crisis, when stewardship and the notion of shareholders as active owners who need to play an active role in engaging with companies to ensure that they're operating in a responsible manner for the long-term benefit of all stakeholders became more prominent. On a principles basis, the notion of stewardship and responsible capitalism and safeguarding of assets and resources for future generations is something that fits very well within the principles of Islamic finance. And in more recent years, and I think the present environment attests to this, investors have also recognized that companies need to take a wider focus than simply profit generation and need to have a more responsible attitude towards towards society and the environment. And stakeholders we see are increasingly calling on corporations to incorporate social and environmental responsibilities into their core decision-making process and into the business strategy. So there's greater demand than ever in not just in transparency, but also in the reporting of financial activities and corporate accountability. I would say also that we have the UN's 2015 Sustainable Development Goals, which represent a set of positive objectives for global development as a framework through which investors' beliefs and activities in both social and Islamic investing can be expressed and can be measured. So last year, for example, we created an SDG aligned index for a large Dutch pension fund, which helped them to achieve both their responsible investment and their climate objectives through their passive portfolio, because it also involved, for example, underweighting companies with high carbon emissions and giving greater exposure to companies providing solutions to environmental issues, including climate change, but also pollution and environmental degradation. So if we can move to the next slide, please. Thank you. So here I want to demonstrate an approach to ESG through an examination of the FTSE for Good index construction methodology. And I think here we can see maybe some of the overlap and also some of the distinction between ESG and Islamic investing. So the FTSE for Good methodology includes an analysis of companies to see how they are managing the ESG risks that they face, and importantly, also provides a basis for engagement with companies on how they're including ESG issues into their business strategies. And you can see at the top of the slide in the dark red boxes some of the ESG issues that we assess companies on, and also that we engage with them on as part of that assessment process. So the range of exclusionary screens, which is set out in the box on the left-hand side, are the standard FTSE for Good exclusions that we apply on a global basis. And you can see here that there's a high degree of overlap with the Shariah business activity screening. But there are important elements of the Shariah screens that don't apply here. And it may be that given the significance of Shariah investing in the market in Malaysia, that this is something that we need to address. Can we move to the next slide? Thank you. So I just want to close with a summary of some of the main points that I hope to cover, but ultimately just want to reiterate the connection between ESG and Islamic finance principles, and also, I guess, on the performance side, the fact that there's a lot of similarities between the two approaches. I think I'm going to wrap up there, but happy to take any questions in the Q&A session.
The fourth polling that we're doing, actually, we want to know, this question actually moves into our next panelist. Do you only invest in Shariah compliant securities? You just click polling there. Our next speaker is, of course, Damshal Awang Damit. He is the CIO of Tabung Haji. Damshal, maybe you can share with us some of your ideas of Tabung Haji's investment strategy, but more importantly, where do you think some of the growth strategies would be, including epicenters of growth for Islamic capital markets?
When talking about epicenters, as already discussed among the panelists, I think for me, it's not about epicenter, but it's already, because Islamic finance is already globalized. So it's not about epicenter, but I think the focus more on innovation. And when I talk about innovation, it should be like two things in my mind for Islamic finance. It's the products, how do you reach the demand? Second, the fund management itself. This is where I want to share my thoughts on fund management in Shariah products. So, okay, the big thing now is the COVID issues, the crisis. Now, when you look into valuation, all this while people are so familiar with price earning ratio or PE ratio. So when there's a crisis, oh, what's the PE, right? On our side, we don't just look into PE. Yes, PE is still important, but when it is crisis, the earnings visibility is not there. So so rather than just relying on PE, we focus more on equity premium. Equity premium is how much the yield an equity will give above the treasury yield, because equity in general is higher risk than treasury or bond or sukuk. So the spread must be higher than the treasury itself or the sukuk itself, because sukuk is less risk than equity. So if I look into the spread, we call the equity premium spread, during the crisis, it is really wide. It is in fact wider than 2012 level. It is at 384 basis point. What it means is that if I invest in equity in March, I will get 384 basis point or 3.8% return higher than the treasury itself or higher than the government sukuk itself. So it is very, very attractive. And if I were to go back into 2012, what created this high spread? Even in 2012, the spread is about 300 basis point. Don't talk about global financial crisis, it was like above 600 basis point. But if I look into 2012, the whole year, the spread is about 300 basis point. It started with, there's a discussion globally about concern on policy makers worldwide that they are running out of tools to avoid another global economic recession. Sounds familiar? So that is the end of 2011. The discussion is on that. And then towards the end of 2012, the two big world economies, China and US, are taking measures to spur growth. They become friends. Okay, so when they become friends, the global economy become normalized, and you can see that the spread normalized. So the issue now, can the spread normalize after crisis? Yes, it can. It's not just about vaccine of COVID, but the two world economies or any the big major economies should work together to spur the growth, not to take on another war or tariff or whatever trade war you should. That's going on. It should be working together to spur the global economic growth. So that's on nation equity. Can I move on to the next slide? So next slide, please. So the next slide is on S&P. Here I'm talking about in the US. The US, the spread is even higher than the global financial crisis. It was like, during March, it was like 560 basis point, which is like 4 standard deviation, almost 4 standard deviation above the mean, where the global financial crisis is 527. So definitely during March, equity market is really attractive for the global market to go in. But at that time, is it sustainable? During that time, the Fed is really scrambling to support the market. What they did, they print money. Okay, so early 2020, the balance sheet of the US is about 4 trillion roughly, or it's below 4 trillion. Now it's already 7 trillion. So the liquidity is really supporting the market. Even Larry Summers, the former US Treasury, said the provision of liquidity cannot override fundamental. The fundamental should be higher than liquidity itself. But that's happening in the US market. In fact, in Malaysia also. But now another element that support the market, retailers. So if I were to look the volatility index in the US, we call it VIX index. During March crisis, COVID, the peak of the crisis in March, the volatility of market even higher than the global financial crisis. So the crisis is real in March, but then it rebounds very fast. So why it rebound very fast? As I mentioned before, liquidity, some factors on retailers. But how do we capture the opportunity of this volatility? I mean, volatility actually present opportunity for us to go into the market. So how do we capture? So one of the factors that we should look into this, is there profit margin? Are there earnings growth in the market? So let's look into the next one. Okay, so if I look into profit margin, especially S&P 500, we can see during the crisis, the profit, especially 9 June, the profit margin is really down sharply. So I can see here from this chart, there is a good correlation between profit margin and S&P. So during 9 June 2020, there's a huge drop in profit margin. That indicates that the index might fall, okay, if it is a good correlation between the two. And true enough, after 9 June, the index fell about 5 to 7%. In fact, the US, the retailers are so, I don't know if I can use the word gung-ho, they even bought Hertz, which is a bankrupt company. So the retailers' force is very, very strong. But I'm not saying it's not bad. I mean, it's good. It's bad. Retailers can enrich the market. So we welcome this kind of movement, but retailers have to be more mindful of the market. That would be a next section for retailers. So that is profit margin. The other thing that I would look as a institutional investors are earnings growth, because earnings growth should by right drive valuation. So let's look into the next slide, please. So we do correlation studies between earnings growth and valuation over the period of 10 years, and we start with S&P 500. Yes, there's a positive correlation. So when we look into a simple correlation, if there is a 5% growth in earnings, in fact, the valuation increased by 21%. It is like 4 times the earnings itself. I think this is where I have shared with you before. The other factors is not just earning in the equity market, is the liquidity, is the free, I mean the huge money flow, and so on. The liquidity is the main factor beyond earnings. The same thing when there's a 5% earnings, a negative 5% earnings, the valuation is down by only 2%, meaning that the market is still supported. That is in the US. But quite interestingly, if I were to look into Malaysian market, next slide please, there is still correlation. However, if there's a 5% increase in earnings, the valuation increase only 8%. Okay, not that much, because liquidity is still okay, reasonable, but liquidity is still within Malaysia. But the interesting part is, if there's earning, the earning is down, I mean there's a downgrade on earnings, minus 5%, the valuation is still positive 1%. So this is quite interesting, meaning that in Malaysia, the market is still supported by the institution. So that's why it is still, I mean, you need to have a huge earnings downgrade for it to be negative. So there is still it's very much well supported by the institution. That's why, as I mentioned before, the big comeback of the retail is very much welcome in this market. Okay, now the question is, earnings is very important for the valuation. So we can see from this capital market, from public market, by right earnings should drive the fundamental, should drive the valuation, but other factors like liquidity comes into picture, politics, all these noises can really affect valuation. So what are the market, especially that is closer to the Islamic finance, which are very much closely related to earnings, I mean closer related to earnings, the valuation is closely related to earnings. So the market that I'm talking about, which we should also look closely for the promotion of Islamic finance, is private equity. Let's look into the next slide, please. So private equity is actually the closest to real economy. So I don't have the graph here, but usually if I were to go into the performance of private equity, usually if you launch your private equity during crisis, we call it vintage years, okay? When you launch your private equity during crisis, usually the private equity fund will be, doing very well. But then in Malaysia, when I spoke to some of the private equity company, when I asked them to launch during crisis. So here during crisis, you can buy a company at cheap, but they say behavioral issues, they cannot get the company for cheap because they don't want to show desperation. So this is quite interesting. So they don't get to buy the companies. But then this is quite funny. When they want to exit, when the public market is going up, they're happy to exit using the earnings multiple of the public market. So we have to be careful on PE. Even though it's closest to Islamic finance, we have to be careful on the valuation. It is sticky when it is crisis, but when it comes to exit during a good market, they are happy to follow public market. So we have to be careful on the valuation of PE as well. But again, private equity to me is the closest to Islamic finance because you are sharing the risk. Next, please. And then there's another challenge as a fund manager, especially on public market or listed company. Different Shariah index have different Shariah parameters, and hence some of them have different performance indicator. For example, if I will go into MICI ACWI is all country world index for the whole world, or global index for Islamic. They have two kind of index. One is on using market value, which is mark to market. The other one is total asset. The problem with mark to market is that the denominator is using mark to market valuation of the market cap. So when there is a crisis, when market cap going down, if you use debt to asset screening, this company will be out. For example, some of the big companies which have big leverage, before crisis they are inside the index, but after crisis, because market cap is down, they are being kicked out of the index. So there's some volatility on market value, whereas total asset is more stable. However, in long run, I'm comparing these two. In long run, market value of this ACWI is actually a better return or better risk-adjusted return compared to total asset. Even though total asset is very much consistent or very much stable, but when it comes to performance, market value based or M series of global index, I think because the market value based index, it is more reflective of the market. Okay, very reflective of the health of the company because it reflects the market. So because fund manager, so what are the factors besides selection of an index that I should look into to mitigate all these uncertainties or to promote sustainability of my fund? So beyond index, what I do, of course, as a fund manager, I look into fundamental. Next, please. One of the factors of fundamental is quality. Okay, quality, if you look into technical part, there are 4 factors. You must have earnings clarity, earnings visibility. You have a good return on assets, quality asset growth. And the fourth factors of quality is actually a good capital structure or a sustainable debt equity component. In other words, the leverage factor of a company must be sustainable or must be within reasonable level. So if I look into leverage, it's a part of the quality assessment. Leverage indicator is actually a big chunk of Shariah finance or Shariah equity component in screening. So in other words, indirectly, as Shariah screening take into account leverage as one of the factors, indirectly, it is looking at quality company. So indirectly, it should be sustainable. Indirectly, it should be stable. I'm talking from academic standpoint. But of course, when you put it into the market, it's still volatile, not because of the Shariah index itself, not because of the screening, but because of the market. Because I mentioned before, the flow in the market will affect the valuation. So yes, the Shariah index is very good in its structure, because it reflects quality. But when it goes into the market, reality strikes. There is liquidity that will influence and this is my last slide. Next, please. Our Islamic investors disadvantage compared to conventional investors. Before I answer that question, I give you one example. In the market in Malaysia, usually MGS or Malaysian Government Securities Sukuk, usually the yield is lower than GII because the MGS yield is more demanded than GII. Because MGS, even the foreigners are buying MGS. So it is very liquid, it is very active. But now, during crisis, there are times that the MGS yield is higher than GII because the foreigners is selling out. So if you are a conventional investor, it's easy. I have both. I sell GII, I buy MGS. It's a simple, optimization for my portfolio. But me, as a fund manager, Islamic fund manager, I just have to watch. No, I think it's not right. So the question is, am I disadvantaged because this? No, I still have options. When GII is down, I can still sell my GII, but I can move to another Islamic finance product. For example, I can go to corporates, I can go into even the equity itself, certain sectors and all that. So the answer is no. Islamic fund manager like me is not disadvantaged, but I have to be creative enough, innovative enough, and competent enough to move around to take advantage of the market, because there's still enough. The market is deep enough for Islamic fund manager like me to optimize my return. And then last question on ESG. Yes, Tabung Haji is now, we are not saying that we are ESG compliant, we are ESG aware. We are aware that the importance of ESG, but not yet fully compliant. But inshallah, we try our best to move into ESG. For that, thank you so much.
Thanks, Damshal. We don't have much time left. We'll just ask 2 or 3 questions. We'll start with Daniel's question. How does Sharia investing promote positive social and ESG activities when the screening criteria mainly focuses on the negative screening? Anybody can take this?
Yeah,
Yeah,
maybe I can,
okay, go.
can start to propose some suggestions around that idea. So what I was able to demonstrate was the fact that actually Sharia, in terms of the fundamental principles of Islamic investing, can marry very well with a broader sustainability approach. And I guess you could say the same thing also of ESG. So, ESG came out of an ethical investment background, which was focused largely on exclusionary screening. What we see today is investors looking more deeply at the opportunity set. So perhaps you could call that the positive societal and environmental benefits that can come out of ESG. So I think it's really taking the opportunity to marry the two elements that can bring about some of those benefits. But I would say really it's the sort of alignment at the philosophical level between the two approaches that give the opportunity to focus not only on an exclusionary perspective, but on what you can achieve in a societal and environmental way through applying both Sharia and ESG into investments.
Perhaps I can add on a bit. I agree. I think for ESG, I think we should go beyond negative screening. I think we should go into positive screening. On our side, that's why on Tabung Haji, we are very much more ESG aware first to ensure that the development of ESG itself to be more comprehensive, not just negative screening, but positive screening. But positive screening is not easy. You have to have good resources, because to go into positive screening, we have to go deep into the company. Are they doing a good initiative to make sure that their company they are looking for positive screening, they are looking into initiative rather than what have been done. What have you done? I mean, your plan to make sure that ESG is client. So we add more value from this positive, but that's why we are more into ESG aware to make sure that this development is in place first before we come in a big way.
Mustafa, Dr. Eskandar, anything?
Sure. I think I just want to echo the same points that Helena and Damshal has made with regards to the evolution of Islamic finance. I mean, there's a lot of overlap between Islamic finance and ESG investing, or Islamic equities and ESG, and you can see that by looking at the respective performance of the two indices of that. Yes, Islamic finance currently looks at negative, or Islamic investing looks at negative criteria to determine what is not permitted, as opposed to positively evaluating what is permitted at this stage. But I think there's a lot of development with regulators, with Bank Negara Malaysia and others that are pushing Islamic investors, Islamic institutions to declare more on that front, right? But the mere fact that you limit certain industries that are harmful, you limit the ability of companies to leverage, and you limit a lot of the synthetic instruments that could be utilized. So you limit derivatives, you limit, other investment criteria, credit default swaps and other things that would, artificially move the market. You make it a simpler market based on more solid fundamentals. The other thing that I would mention, echoing what Damshal said, is data is very important, right? So even entities that want to do screening, it's very important that they have good, accurate data. And what I would say at this stage is regulators need to take a very, very strong approach, because the absence of a standardized data framework is more harmful than not having it, right? Because currently the situation you face is every single company can showcase the best aspects of its ESG criteria and hide the worst aspects of it, because there's no standardized disclosure requirements. It's only when you have standardized disclosure requirements that everyone will have to be on a level playing field. That's the only way where you can compare compare, two different companies. If every company is allowed to showcase whatever they want and hide whatever they want, there's no comparability. And if there's no comparability, then there's no accountability. So, you need to have the disclosure requirements in place so that investors can compare and investors can divert their money to those initiatives that meet their understanding from an ESG consideration, as well as a risk and, financial metrics and other considerations as well. So those are the 2 points that I would mention.
Okay. I'd just like to add one point. I think despite the fact that one is looking at positive screening and the other one is also looking at negative screening, but one common factor or attribute that they share together is the impact assessment. I think this is where I think the ESG and also Islamic finance are coming together. So we are not just looking at risk and return per se, profit on paper, but we are also trying to basically translate the impact to the society, to the environment, and also to the continuity of our so-called ecosystem. In fact, there are companies out there, for example, like Sedco Capital, so on and so forth, are marrying the two criteria and providing a unique value proposition to the customers itself. So despite the fact that one is positive and other negative, but eventually you will boil down to what are the positive impact assessment that they are making to the society. So this is where I think philosophically we can actually marry the two. Thank you.
Yeah, I'm really sorry for my panelists, but we have to draw this conversation to an end. There were some constraints in terms of timing, but for the viewers right now, you can actually contact these speakers directly. I'm sure you can get access to them and perhaps share your views there. But so far, it's been plenty of conversations that have been taking, and it's very interesting for us to continue this conversation even further. Thanks again for each and every one of our speakers, Mustafa, Dr. Helena, and of course Damshal, who's seated next to me. And perhaps we can continue this conversation in the future. Let's take a break. When we come back, we'll have the session 3 in process.